All right. Good morning and welcome to Basics of Financial Statements. My name is Brendan Coyle. Today I'm going to be discussing the basics of financial statements, what they are, who uses them and why, what the elements are that make them up. Let me start off by giving you a brief background of my background. I've been a manager for many years, most of which have been involved in using financial statements to manage a business. I've been a vice president of hardware and software computer companies. I've also been the COO of different companies. My bachelor's degree is in math and computer science from the University of Illinois, Chicago, and my MBA is from Northwestern University in Evanston, Illinois. As I said, we're going to be talking about financial statements and primarily focusing on an example that will allow us to show the various components that go into a financial statement. One thing I'm not going to be talking about, though, is how you go about constructing a financial statement. Because unless you're going to be an accountant or a CPA or work for an accounting firm, there's really no need to go into the basics of building a financial statement. What you would do is, if you're running a business, is you would get a financial accounting package like QuickBooks or EasyBooks or any one of a dozen others, not recommending anyone specifically. And that would allow you to enter your sales and your expenses and then select the reports you wanted. So there's no reason to go into the detail. So let's get started here with the basics of financial statements, who uses them and why. Typically, financial statements' purpose is to provide information about the results of operations, financial position, and cash flows of an organization. The information is used mainly by two groups of people. One is the management of the company to show how they're performing against their goals and their metrics. The other is investors, which could be either equity or debt investors. An equity investor is someone who's buying stock in a company, so they're buying a piece of the company for hopefully growth or return and through dividends. A debt investor is typically someone who is loaning money, which could be a bank. In many cases, a small business is either going to go to a bank or, quite honestly, to Uncle Joe or your father to borrow money. Or if you're a big enough company, you'd be selling bonds, which is just a different form of debt instrument. What are the basics of the financial statements? Well, you're going to find financial statements consist of three different documents: a balance sheet, an income statement, and a cash flow statement. And typically, you'll see them presented in just exactly that order. The balance sheet consists of three components: the assets, which are resources that are owned by the company that the company uses to actually operate the business; liabilities, which are amounts that the company owes to other individuals, for example, if you had loans, etc. And then equity is, on paper at least, the difference between assets and liabilities, or what the company is worth. Now, I say that on paper because typically if you're going to buy a company, you're not looking at simply the equity that listed on the books. You're going to look at what it's able to generate for you going forward. So that's the balance sheet. The next one is the income statement. The income statement will show you the income the company is bringing in, the cost of sales, and the gross profit. So if you take the income minus the cost of sales, now the cost of sales, if you're a manufacturing company, the cost of sales is the amount of money you spent on parts to build the product that you're selling. If you're a service company, cost of sales is typically going to be the cost of the manpower you're using to deliver the service. But if you subtract the cost of sales from the income, you get your gross profit. From that, you subtract the operating expenses. And operating expenses are those expenses you use to run the business, which would be salaries, rent, marketing, etc. Those would be your operating expenses. You subtract that from your gross profit and you get your net profit. The last thing you would do on your income statement is list other revenue, which could be from investments you might have. The third document in the financial statements is the statement of cash flows, because it's important to understand where your cash is coming from and going out to. You have to have cash. If you don't have cash, you're not able to pay the bills, you're not able to pay your salaries, etc. So you have to have cash, and it's important to know where it's coming from. You want your cash to come from the operation of the business, as opposed to simply borrowing money. If all you can do is to raise cash is borrow money, that means you're not able to collect on your sales, or your sales are insufficient. in which case you're not going to be able to get anybody to invest in you. So that's what the financial statements are. Now we're going to look at our example. And let me see if I can stop sharing for a moment and go to share a different document. And this is the example we're going to use. This is an example of a small manufacturing company that produces widgets. And you might ask yourself, what's a widget? A widget is simply a term used to indicate that they manufacture something. It's kind of a generic term for a manufactured part. One of the first things you'll notice on the balance sheet here is the date. It's typically your balance sheet is produced at the end of your fiscal year. In this case, it would probably be June 30th, 2002. And it shows the state of the business as of that particular date. And I do mean as of that particular date. It's not as of the 29th, it's as of the 30th of June. You see that it says unaudited. Unaudited means that these were probably prepared by the internal accounting department, and they're very useful for the management of the company, but they're not useful if you're going to go out for investors, because investors want to see audited financials, meaning they were prepared by a third-party CPA or auditing firm who have validated that the numbers that are on these statements are correct and have looked at the detail in building up the numbers. So if you're going to be going out for a loan or you're going to be going out to investors to try and give you money, you must have audited financials. Next thing you may notice is that it shows 2001, 2002. Typically, you'll see 2 years of results on any financial statement, so that you can compare how the numbers are being produced, and how the business is growing or not growing. If you're a big public company, you would probably have 5 or 10 years, so the investors can look at a more granular level of growth. But in this case, since it's probably just for the internal management, 2 years is sufficient. Assets, as I said, are resources owned by the company, and they're broken down typically into current and long-term assets. Current assets are assets that are expected to be used up in the first year, which would be things like cash. In this case, I do mean cash. This is money that would probably be in the bank. Accounts receivable, which is money that you are owed from individuals. Deposits and prepaid expenses. Deposits could be bank loans, or it could be prepaid expenses, meaning, for example, if you paid your rent from the 15th of the month to the 15th of the month, since this is produced at the end of the month, you would have half a month's worth of rent that you were still good for. So that would be considered a prepaid expense. And then inventory is the amount of money you've got in parts in inventory. So that gives you current assets of $216,608. Property, plant, and equipment is exactly what it says. Property meaning real estate, plant meaning factories or buildings, and equipment meaning typically the equipment you have that is producing, if you are a manufacturing firm, producing your parts. Notice it says Note 2. In any set of financial statements, there's going to be notes which explain pieces that come before the notes in the financial statement. We'll get to the notes when we get to the end. And then finally, investments. If you had investments where, for example, you may have put money into another company, something like that, that would be listed here. Those are your assets. The next is liabilities. And again, liabilities show current liabilities, which are liabilities that are typically required to be paid within the next year. So bank overdraft, which they no longer have, bank loan, which they no longer have. Accounts payable and accrued liabilities. This is, accounts payable would be money you would typically owe your suppliers for products that they've delivered. Accrued liabilities could be something where you've promised to deliver a product, but you haven't delivered it yet, so you still owe the customer that product, and that would be an accrued liability. And long-term debt, current portion. Since this is only showing the current liabilities, it's not going to show the entire long-term debt. It's only going to show the portion that you're going to have to pay in the year for the current portion. And then income tax payable, because we've always got income taxes. Due to shareholder, Note 3, it'll explain later on, but this is amount basically that you borrowed from the primary shareholder. This is not an equity investment. This is a loan you've gotten from the investor, which could be your grandfather or your uncle or whoever. And then long-term debt would be the remaining portion of the long-term debt, and that is typically what you would get in a bank loan. Finally, there's shareholders' equity. Now, shareholders' equity will typically have two components to it. It doesn't have it on this one, but typically there'll be two components. One is paid-in capital, which is the amount of money your equity investors have paid in, which is the amount of money you sold shares for. Retained earnings is a cumulative number that shows the amount of money that you've earned over time. If you look at the numbers here, it shows a minus 61,350. So as of the end of 2001, you had lost 61,000 in your ongoing business. This year, you're showing a net retained earnings of 17,166. So that would mean that you've made $78,000 this year because you've wiped out your minus 61 and have a positive of 17. So that's what your balance sheet will look like. Next is your income statement. Starting off with the income statement, the first thing you'll always see is the revenue. So you can see that the revenue is relatively constant. It's down a little bit from 2001, but it's relatively constant. So that's a good thing because you don't want to see your revenue go down. However, you would prefer to see it go up significantly. Cost of sales. Now, I mentioned before, cost of sales is typically the amount you've spent on products to build your product. So the way you calculate it if you're a manufacturing firm is you take your opening inventory. So you had 156,000 in inventory when you started. You've got 1,600 out for delivery, meaning it hasn't been taken possession of yet, so it's still considered your inventory. And then purchases, you bought almost $741,000 worth of additional inventory for a total of $899,000 in inventory that you've spent. You've got $159,000 left, so the total amount of money that you went through for your inventory this past year was $740,000. So that would be your cost of sales. You sold $1,104,000, so that your gross profit is now $364,000. Operating expenses are $286,000. Most of the time you'll see in financial statements, they'll list the operating expenses right in line with the rest of the income. In this case, they've decided to put it on a separate schedule, so we'll look at that separate schedule in just a couple of moments. So your income from your whole operation is $77,855, which is your gross profit minus your operating expenses. Other income or expenses. This is where you would list things that are not part of the operation. So in this case, it would be if I dispose of plant, property, and equipment, if I sold off an investment, in which case they brought in $16,000. And miscellaneous can be any other things that they've come up with. So they've added $15,000 to their overall revenue. So their net income before they put down taxes is $92,000. They allocate for income tax. Now this is the allocation that they've given for income tax expense. They haven't necessarily paid this yet, but this is what they're calculating their income tax to be, which gives them a net income of $78,516. They had a deficit, if you remember, of $61,350 from the beginning of the year. So the retained earnings for the end of this year is $17,166, which if we go back to the balance sheet shows $17,166, so it matches up. Now let's skip the statement of cash flows for the moment and look at the operating expenses. Operating expenses are consisting of things like advertising, amortization, which is basically the amount of money they're paying off on their loan, bad debts, bank charges, which is the fees you pay the bank, insurance, etc. One of the biggest numbers, and typically you'll find is the biggest numbers, is wage and benefits. That and rent are typically your biggest numbers because typically your manpower is the most expensive thing you've got, and you've got enough people that it's going to be the biggest expense you typically will have. So you see that the total expenses are $286,817, which if we go back up to the income statement will match $286,817. So that's your income statement. Now we'll look at statement of cash flows. This is one that people tend to, the casual investor tends to ignore, but the serious investor pays a great deal of attention to. Cash from operating activities. This is probably the most important one that you're going to look at, because this shows whether or not the business is able to generate positive cash. So the way you do this is you start off with the net income for the year, $78,000. You add back in the amount you spent on amortization, because that's not money that would typically go out in terms of operating. Gain on investment you subtract, because that would be cash that comes in, but it's not from operations. So your cash from operations is the 78 plus 17 minus 16, or $80,000. Now you take away certain amounts from that amount. You add in the accounts receivable, you take away the deposits and the inventory change, you take away the accounts payable, you add back in long-term debt and your income tax payable, and therefore your total amount of cash from your operating activities, just from your operating activities, was $115,000, which is not bad. That means you're generating a very positive cash flow. Now you look at the cash flow from investing activities. So you subtract the amount you got from interest you paid on your acquisition of property, and you add into that the total amount you got from the disposal of the investment, which means you got $59,724 from your investing activities, which is nice, but it's not as important as the number from the operating activities, because that's the ongoing business you can expect. If you're a manufacturing firm, you're expected to generate money from your manufacturing, not from your investing. Finally, there's cash flows from financing activities. So you paid off a shareholder $180,000. That took away $180,000 with the cash, but you borrowed $86,000 from the bank. So your net from financing activities is minus $94,000. So in terms of looking at your cash increase, total cash increase or decrease, you would take your 115 from operating, your 59 from investing, you'd subtract the 94 from your financing, and that gives you 81,000. You started the year at a minus 69, so that says your cash resources at the end of the year are 552, which, if we go back to the balance sheet, matches up to the balance sheet of 11,552. That's your cash. So you always do some reconciliation to make sure the numbers are matching up. So we've already looked at the expense side of the income statement. Now we'll look at the notes. The first note you'll typically see is a note describing what the business is. It says it's a Canadian-controlled private corporation, subject to the Business Corporations Act of Ontario, which is the Canadian version of GAAP. Was incorporated in this state and operates as a manufacturing of widgets in any town in Ontario. Now, here's the ones that we will pay more attention to. Inventory. The inventory is valued at the lower of cost or market. That's a very conservative way of doing it. That means I value my inventory, the parts that I've got in inventory, either at the lowest of how much I paid for them or how much they're now worth. So that's very conservative. The cost being determined on a first in and first out basis. You can cost your inventory one of two ways, either first in, first out, or last in, first out. So imagine a tube and you poured all the parts into this tube. If I'm calculating it on the first in, first out, I'm taking out from the bottom of the tube because those are the first ones that went in. If I'm calculating on last in, first out, I would calculate them based on taking them out of the top. You can do either one, but it's important to stay consistent. And that's what people will look at, because if you change from first in, first out to last in, first out, they're going to want to know why. Property, plant, and equipment. Stated at cost less accumulated amortization. And amortization is rates defined as the cost of the capital assets over the useful lives. This means what I do is I take the initial cost of the furniture and equipment or vehicles or computer equipment, whatever, and I make them worth less each year. This shows that for my furniture and equipment, I take 20% declining balance, which means, let's say it costs $100. The first year I take 20% of that, which would be $20, and now I say the part is only worth $80. The second year I take 20% of the $80, not the 100, and so my part now after 2 years is only worth $64. That's what the declining balance means. My leasehold improvements, I do straight line, which is a little different way of calculating it. Since it's straight line for 5 years, I take a fifth every year off of the value of the part or the leasehold improvement. So if my leasehold improvement was $100, after the first year it's worth 80, after the second year it's worth 60, so on until it's not worth anything anymore. So they show you the property, plant, and equipment, and if I take 10,200, if I take 12,750 and I take a 20% declining balance, that means the next year it's only worth 10,200. This shows the accumulated depreciation, which is the initial cost minus the accumulated depreciation is what it's worth now. And I do that for all the various components of my property, plant, and equipment. Now, we saw the note that I borrowed money from a shareholder. This says the amount due to the shareholder bears the interest at a rate determined annually and has no fixed terms of repayment. That means I pay off the interest and I don't have a fixed date that I have to have the loan repaid. It does also say, though, that the interest paid was this much. That means that I paid off $18.23 this particular year, and I paid $68.31 the prior year. So I don't have to pay any particular amount of the principal, but I do have to pay the interest at a certain rate. The bank loan is a long-term bank loan. It's bearing interest at prime plus 2, which means I'm going to pay interest on the loan every year of prime plus 2. Prime is currently running around 5 to 5.5%. So my interest on the loan is 7.5%. Now that means it can change because if prime goes up next year to 12%, I will be paying 14%. So it's in my best interest to hope that prime stays very low. It's payable in monthly principal installments of $2,100. So what I do is I pay the interest plus $2,100 a month, which is $25,000 a year. $2,000 a year through November 7th. And it's secured by a general security agreement on the assets of the company, meaning my property, plant, and equipment is what's guaranteeing this loan, so that if I fail to pay off the loan, they will seize my property, plant, and equipment. So that's why the current portion of the loan is worth $25,200 because I have to pay $2,100 per month in terms of the principal. My initial loan was $111,000, so I'm now owes $86,000, which was the amount we saw on the balance sheet, and it shows the list of approximate payments. Finally, there's stated capital. Authorized is the amount of shares that have been authorized by the articles of incorporation or by the board of directors. This says there's an unlimited number of common shares authorized. That doesn't mean they've been sold or given away. That means they're on a limited number that have been authorized, which would mean that if I decide I want to raise more capital, I don't have to go back to the board or modify my articles of incorporation. I can just go out and sell as many shares as I want, bring in as much money as I want. And then there's also a limited number of non-cumulative, redeemable, voting, Class A special shares, which I'm not going to go into all the detail, but that means that they're Class A special shares are special types of common shares. Non-cumulative means that they don't accumulate in terms of voting. Redeemable means that they are redeemable going forward at a specific time for a specific amount. Issued is the number of shares that have been issued. We've issued one common share to one stockholder, which is probably the owner of the company. So that is the financial statements in summary. I know that's been kind of quick going through them. If you have any questions, my email is bcoyle@qe2systems.com. Feel free to drop me an email, and I will answer as quickly and correctly as I possibly can. I appreciate your time this afternoon. I hope you've enjoyed this, and I hope you found it useful. Thank you. Bye-bye.